Hi everyone. Today we're going to be going through just a quick introduction to financial accounting and reporting. So this video is not too bad. It's just kind of some definitions and just to get our feet wet and see kind of what we're dealing with here in financial accounting and reporting. Okay, so the first thing is financial accounting. Financial accounting is considered to be when a company creates financial reports for external stakeholders such as stockholders and creditors and internal users such as managers and other personnel. Okay, so basically what's happening here is that this is going to be used by investors to determine whether or not it makes sense to invest in a company. So basically what we're doing is we're just trying to report on the operations of the firm for those who are external to the firm, such as these creditors and these stockholders, but then also people that are inside the firm, right? Anybody that might invest in the firm, they want to have information, and that's how we get them the information is through financial accounting. All right, and then on the other hand, we have managerial accounting. Okay, so managerial accounting. And so managerial accounting is when a company reports on its operations for internal stakeholders, such as managers or other personnel. And basically, managerial accounting, a lot of the times, what we're trying to do is we're trying to control costs or evaluate operations. And so we can kind of see the difference in focus. Financial accounting is generally more outwardly focused on the investors versus managerial accounting, we're focusing more on the internal operations, kind of controlling costs and evaluating the operations of the firm. Okay. And then the next thing is we have to look at what are these different financial statements that we have in financial accounting. Okay, and basically the financial statements are just the main way the firm communicates its financial results to parties outside the firm. Okay, and so basically it just means this is kind of the way that the company is going to, it's the main way. There are other ways, and we'll see that in a minute, but it's the main way the company says this is kind of how we're doing as a firm financially. Okay, and there's 4 statements. Generally speaking, when we talk about the financial statements, we're talking about 4 statements. Those are the balance sheet, the income statement, statement of cash flows, and then the statement of stockholders' equity. Okay. And then if we slide the paper up here, we have a couple other items we have to deal with. So the next thing, this is the other way that companies report or they get information out to their investors. Okay. And this is called financial reporting. Okay. And so financial reporting is basically these additional methods of communicating information to external parties on top of the financial statements. Okay, meaning, in addition to the financial statements, there are other ways of reporting information, and basically this would be considered to be financial reporting. So this would include items such as annual reports by a company or forecasts or supplementary schedules, meaning, they're disclosing information about their future cash flows, or they're giving you more detail about a specific transaction. Okay. Now, financial accounting, it helps investors or helps users make investment decisions, and then it helps promote a healthy, encouraging, and efficient flow and allocation of capital. Okay, an efficient allocation of capital is basically the main thing that financial accounting helps us with, and so it promotes a healthy economy because we can, as investors, we can make decisions about what companies we would like to invest in. And so that's one of the main goals of financial accounting. Okay. And then the objective of financial reporting is to provide equity investors and creditors of the firm with decision-useful information. This is very important. Decision-useful information about the operations of the firm. Okay. What does that mean? Okay. Decision-useful information means that it allows the investors to determine how good the company is at making money and how well the investments are protected by management. Okay, so with financial reporting, we're basically trying to provide these investors and creditors with this information that it's useful to them, right? It allows them to make a decision, right? Because we kind of talked about at the beginning, up at the top here, we talked about, well, this is how we're going to determine through financial accounting whether these investors are going to invest in a company. Right, and so this decision useful information that we talk here at the bottom, that's going to help them determine, okay, are they doing a good job making money? Should we invest in them, basically? Okay, so let's flip the page here, and we just have a few more things to go through on this lesson. Okay, the next thing is We're going to hear this term a lot. We're going to hear GAAP a lot in this class. So generally accepted accounting principles, that's what GAAP is. And so what is GAAP? Well, it's the rules we follow when we record transactions for financial accounting purposes. Okay? And so basically there are two ways that GAAP can form. Okay? It's either going to be set by an authoritative standard set by the Financial Accounting Standards Board, the FASB. We're going to hear a lot about them. And so basically that sets the standard financial accounting in states. Or the is that there can be a practice that did over time in the profession and it's widely used. So that's why we call it generally accepted accounting principles, right? Because basically it's set by the FASB, so it's just a rule that the FASB says, okay, you need to use this to account for a certain transaction. Or on the other hand, the profession decides, oh, okay, like we're gonna account for a certain transaction in this specific way, and everyone adopts that, and so that's the other way GAAP can basically become a thing essentially. Okay. And finally, we have one definition that we have to look over here. And the entity perspective. Okay, so this is going to be the entity perspective. And basically what that means is companies are viewed as separate and distinct from their owners. Okay, so meaning that companies are going to record transactions that they engage in with third parties in their own separate accounting records. Okay, meaning that if we have a specific company and they engage in a transaction with another third party, they record it on their accounting records versus if the owners have a transaction with that same third party, the owners record that on their own accounting records, right? So the owners are separate and distinct from the company because that way we can basically say, okay, we're just going to identify all the transactions that happen within the company and account for them as just one entity. So that's the end of this lesson. I hope that was helpful, and yeah.